Today, the life simulation you will experience is that of a billionaire. At 2:17 a.m., your bonus is credited $240,000. Your base salary is $210,000, making your total income this year $450,000. 10 years ago, this number seemed out of reach, but now it appears on your payslip. By the weekend, it's split between taxes, rent, and brokerage transfers. At 9:41 p.m., your Bloomberg terminal is still on. As an investment bank vice president, you execute bond issuances, acquisitions, and capital restructurings, managing deals from $300 million to $2 billion. Analysts build models while you drive the process. On paper, you're in the top 1% for income. Your rent is $6,500 a month, and your tax rate is about 45%. Your brokerage account recently topped $1.8 million. To most people, it would seem like you've already won the game of life. But the first time you sit across from a private equity partner worth $80 million, the scale changes completely. The meeting is about acquisition financing. Your bank arranges the debt package, and his fund is acquiring the company. You present the data, and he reviews the capital structure in 2 minutes, asking only one question about leverage capacity. 10 minutes later, the meeting ends. If the deal goes through, the equity returns could reach $70 million, your bank will collect $6 million in advisory and financing fees, and your share has long been predetermined. Next year, it will be paid out as a bonus, calculated by a compensation committee you've never met. At that moment, the gap becomes glaringly obvious. Your income is high, but it's still linear, paid out according to the payroll cycle, and it stops if you stop working. Each promotion brings a raise. The people above you are on a completely different trajectory. They don't optimize for salary, but for ownership. Once you start noticing this distinction, you see it everywhere. Senior partners talk about equity, private equity talks about carried interest, and investors talk about assets under management. People at that level don't talk about salary. They talk about positions, because at the very top of the 1%, money isn't something you earn, it's something you hold. When your investments start generating significant returns on their own, your relationship with money changes. Your net worth surpasses $5 million. For the first time, your capital can generate returns without needing your time. At this moment, you're no longer just someone who makes money. You become something else, an accumulator. Your net worth crosses $5 million. The number grows gradually. It's not an overnight windfall. Bonuses, equity compensation, market returns, and years of disciplined investing all accumulate together. At first, nothing changes. You still work late, sit in the same office, and reply to emails at midnight. But the math starts to shift. The returns from your investment accounts are no longer insignificant. In a good year, your investment portfolio can generate an extra $600,000. And in some years, the returns even surpass your salary. For the first time, your money truly starts making more money, and you begin to pay more attention to asset allocation. Index funds seem too simple now. You turn to direct investments in private equity funds and tax-saving structures introduced by private bankers. This conversation began the year your assets surpassed $3 million. The bank gave you an advisor because your asset size qualified you for the private client criteria. The tone shifted instantly. Retirement planning was no longer mentioned. You started hearing about portfolio construction, asset allocation, private credit funds, venture capital exposure, and direct real estate partnerships. At this level, the goal is no longer income, but compound growth. You notice people around you changing. Conversations shift from careers to investments, equity, and trading. Some acquaintances are now venture capital partners, some own stakes in logistics, and others joined real estate deals for a $120 million property. You see how the next level of wealth is created, not from salaries, but from assets gaining value while owners sleep. Your job brings income, but your capital brings something else. Freedom. When your investments can generate 7-figure returns in good years, you have crossed another invisible boundary. After this, work becomes optional. You stop focusing only on accumulation and begin allocating your capital. The transformation starts now. You no longer act like an accumulator, you think like an investor. Your net worth exceeds $20 million. This number changes the way you evaluate time. The returns from your portfolio are now high enough to replace the salaries of most professions. In a good year in the market, you can make $2 or $3 million without a single meeting or phone call. Work becomes optional, but something else replaces it: opportunity. You start receiving invitations to deals that never appear on the public market. A venture capital fund reserves a spot for you in their next round. An operator invites you to a $300 million private acquisition of logistics assets. A former colleague invites you to join their new private credit fund. These opportunities circulate privately without advertising. The people approaching you want capital partners, not just investors. Your role begins to shift. You're no longer just investing through funds and portfolios. You start participating in deals. Some succeed, some fall through. But the pattern is clear. The most substantial returns don't come from the public market, but from ownership of private assets. When you start owning a part of a business, not just its stock, another transformation takes place. You no longer think like an investor, you start thinking like an owner. Your net worth surpasses $100 million. At this level, you no longer think in terms of portfolios, but in terms of control. Owning company stock is no longer the goal. Holding significant equity stakes is. You join acquisitions, not just funding. Private equity firms invite you to co-invest, helping buy multi-million-dollar firms. You join the board, where quarterly meetings replace earnings calls. You no longer just analyze companies. You participate in setting strategy, hiring executives, approving expansions, and managing risks. The distance between capital and results becomes shorter. When revenue grows, you see it directly. When costs rise, you sense it immediately. Ownership brings a different kind of responsibility, and it also brings something else: scale. When your capital starts entering transactions worth billions, your role shifts once again. You no longer think like an owner, but operate as a capital allocator. Your net worth surpasses $1 billion. At this scale, you no longer focus on individual companies, but on the flow of capital. Your wealth is spread across funds, holding companies, and structured instruments, allocating billions across industries, infrastructure, energy, private equity, and credit markets. Your team now handles individual balance sheets. Your role is to decide where capital flows next. You meet with fund managers, sovereign wealth representatives, and institutional investors. Discussions focus on multi-billion-dollar allocation strategies, not single transactions. A single decision to increase exposure in an industry can direct hundreds of millions into it in months. Capital flows like a current you help steer. At this level, wealth no longer belongs to individuals, but becomes institutionalized. Your capital operates at the market, industry, and even government levels, on a scale most people cannot imagine. Eventually, you realize one thing: even billionaires are not at the very top. Above them are those who design the architecture of capital flows, the architects. Your wealth is no longer measured by personal net worth, but is hidden within structures, trusts, family offices, and holding companies across different jurisdictions. Your capital moves across borders via funds, institutions, and partnerships. You bypass individual transactions, focusing on allocation directives, infrastructure, sovereign collaborations, and multi-year commitments. Governments need investment, pension funds need returns, and markets need liquidity. Your role is to decide where global capital flows next. These decisions shape industries before public awareness. You are no longer trading within the market. You are involved in deciding which markets receive capital first. When wealth reaches this level, one thing becomes abundantly clear. In the world of the top 1%, true power is never about salary or even net worth. It's about your position within the capital structure. In a glass office building, a young analyst opens a terminal for the first time. He thinks this world revolves around money, but he will eventually realize that it revolves around structure.